No crash, no ticket, same car. Then your renewal arrives and asks for more money. It feels like a penalty for something you never did. But that reaction reveals the first hidden rule of car insurance. Your premium is not a report card on your past. It is a prediction about the next claim. And that prediction includes people, streets, repair shops, storms, and courtrooms you may never see. So what exactly changed if your driving did not? An insurer is selling a promise to pay for future losses. Before those losses happen, it estimates two things: how often claims may occur and how expensive those claims may be. In simple terms, expected cost is frequency multiplied by severity plus the cost of operating the system. Your own record matters, but it is one input inside a much larger forecast. A clean record can lower your risk without freezing the price around you. Insurance works because many drivers pay into pools and a smaller number make large claims. The company does not wait to learn which specific driver will crash. It groups people with similar characteristics and prices the expected losses of that group. That is why "I did not have an accident" and "my premium increased" can both be true. You avoided a personal loss, while the projected cost of the pool changed. Now widen the frame from your car to your zip code. Where a vehicle is garaged can reflect traffic density, theft, weather exposure, accident patterns, lawsuit costs, and state insurance rules. Move a few miles, or stay still while the loss experience of your territory changes, and the forecast may move with it. The renewal envelope looks personal. Part of the math may be describing the neighborhood around you. Next, look at the car itself. A bumper used to be mostly a bumper. On many newer vehicles, it may sit beside cameras, radar, parking sensors, and wiring that must be checked or calibrated after a collision. The Government Accountability Office says advanced vehicle technology can require more specialized knowledge, equipment, and information to repair. A small impact can therefore create a surprisingly complex invoice, even when the exterior damage looks ordinary. The numbers show how quickly repair pressure accumulated. NAIC data found the average incurred loss per collision claim rose from $6,113 in 2021 to $7,191 in 2022, an increase of 17.6%. That is a historical snapshot, not today's average. But it reveals the mechanism. When each covered collision becomes more expensive, insurers do not need you personally to crash before future pricing responds. A serious accident may involve far more than bodywork. Liability coverage can pay for another vehicle, medical treatment, lost income, legal defense, or injuries that develop into a long claim. Parts, labor, rental time, healthcare, and litigation can all affect severity. Your premium is therefore connected not just to what your car costs, but to what your car could damage and what an injured person may need afterward. This pressure reached drivers in waves. The Bureau of Labor Statistics says the National Motor Vehicle Insurance Index rose 20.3% in 2023, then 11.3% in 2024. In 2025, the increase slowed to 2.8%. These are national December to December changes, not a promise about any one renewal. But they show why millions of careful drivers opened envelopes that seemed disconnected from their own behavior. Here's the part most explanations now miss. By June 2026, the National Motor Vehicle Insurance Index was 4.1% lower than a year earlier. So no, the national average is not still surging. Yet your renewal can rise. Why? Because a national index blends different states, companies, vehicles, customers, and renewal dates. An average can fall while your particular slice of the market moves in the opposite direction. Insurance prices do not update like gasoline signs. Companies analyze losses, file or request rates where required, receive state decisions, and apply changes when policies renew. The Treasury Department reported that private passenger auto liability premiums written rose 12% in 2024, while physical damage premiums rose 14%. It also noted that 6-month policies allow more frequent resets. Your bill can therefore reflect an earlier cost shock, arriving on your renewal calendar later. There is no single American car insurance price machine. States decide required coverages and regulate rating differently. Local accident patterns, uninsured driving, theft, weather, court outcomes, and repair markets also vary. A factor allowed in one state may be restricted in another. That is why a national headline cannot explain your number by itself. The real investigation has to move from the country to the state to the carrier to your policy. Traditional rating may consider your driving history, claims, vehicle, use, annual mileage, coverage limits, deductibles, household drivers, garaging location, and, where permitted, a credit-based insurance score. Change one item and the comparison may no longer be apples to apples. Sometimes the driver changed nothing, but a discount expired, a vehicle aged into a different repair profile, or the carrier recalculated the group. The opacity is what makes the increase feel arbitrary. Telematics promises to make the forecast more personal. A phone or vehicle device may measure mileage, time of day, location, hard braking, rapid acceleration, cornering, or phone use. That can reward some driving patterns. It also creates a trade, a potentially more individualized price in exchange for more behavioral data. The NAIC warns that programs and data practices vary. Drive safely is no longer the only question. It is also, who gets to define safe from the data? Two companies can look at the same driver and quote different prices because their customers, claim history, expenses, models, discounts, and appetite for a market differ. One carrier may want more drivers like you, another may already have too much exposure in your area. That does not prove a quote is fair. It does explain why shopping is not merely hunting for a coupon. You are testing several competing forecasts of the same risk. Start with a controlled comparison. Put the old declarations page beside the new one. Check the same drivers, car, garaging address, annual mileage, limits, deductibles, endorsements, and discounts. Ask the insurer what changed and whether a surcharge, discount, rating factor, or statewide rate revision is involved. A lower price with much lower protection is not the same product. The goal is to isolate the price change before deciding what it means. Then compare like-for-like quotes from more than one carrier, using identical limits and deductibles. Verify that household and mileage information is accurate. Ask about discounts you actually qualify for, and check your state insurance department for consumer guidance or complaint options. Telematics may help some drivers, but read the privacy and pricing terms first. This is not about outsmarting mathematics. It is about refusing to compare numbers whose coverage is secretly different. Your renewal is not saying, you became a worse driver. It is saying, our forecast for insuring this combination of person, vehicle, place, coverage, and risk pool has changed. That forecast can be reasonable, mistaken, competitive, or opaque. But once you understand its parts, the envelope becomes less mysterious. Safe driving controls one important input. It never controlled the entire system built around the road. So remember the hidden rule. Car insurance is priced for the claim that might happen, not as a reward for the accident that did not. Follow the money, and the personal bill reveals a shared system of repairs, injuries, data, regulation, and risk. If this changed how you read your renewal, subscribe. Next, we investigate another bill that can rise even when you use less, your electric bill. Follow the money, see the system.